Hi everyone, this is Zhu Yi from the Austrian perspective. Today is January 6, 2012. We all know that the market is really efficient, but sometimes there's just some of the facts that the market ignores. And there's really one important fact that happened 2 months ago, and that was in China. Well, actually, a little bit more than 2 months ago, but anyhow. And it was about the People's Bank of China changing the measure of M2 money supply. So what did the People's Bank of China do to the measurement of this empty money supply, right? So basically, they added the term deposits of non-depository institution and depository institution. But I mean, it does sound really repetitive and somewhat complicated. But when you think about it, deposits. First of all, what are deposits? Right? Deposits are money, right? And what are non-depository institutions? Like they are like insurance firms, social security, funds, retirement funds, or security companies. Right? Those like in China counted as non-depository institutions because they don't take people's money and store it for them. And of course, depository institutions are like banks, right? I mean, they take people's money and they pay interest. Well, they don't pay that much nowadays, but they're counted as depository institutions. And what this implies is that as the increasing amount of money that those non-depository institutions park into those banks, right? I mean, the amount is just so great that it really affect the accuracy of empty money supply that the central bank has to refine the measure of empty money supply in order to take into account of this increase. And here's what the Chinese media basically just stopped, right? I mean, all they report is like, People's Bank of China just to refine money supply, and that's it. I mean, they don't even go behind the reason why and analyze it, right? So, what the Austrian perspective here is trying to do is really to tell you why, all of a sudden those non-depository institutions are parking their money into those banks and instead, not investing elsewhere. One of the most important reasons that I think has contributed to this change is because of the great regime uncertainty created by the Chinese government. Right? Regime uncertainty, first of all, I should explain it. Is a term coined by Robert Hicks, describing the situation in which businessmen face great uncertainty due to government intervention in the economy. Right? I mean, the government keep changing its policy, causing really great deal of uncertainty in the business environment. So businessmen cannot make accurate predictions to the future. For instance, he doesn't know whether the interest rate is going to stay at say 3% or is it going to rise to 20%. He doesn't know, right? Or he doesn't know whether the government is going to strengthen its property right in the future, right? I mean, is the government going to all of a sudden turn from being capitalist to all of a sudden turn to become a communist, right? Take all its property, right? So if he's unsure about that, the businessman is really going to be reluctant when he's making investments. Right? He doesn't know whether he should lend money to the guy who's going to build a bridge between the islands. He doesn't know. I mean, he doesn't know whether he should lend money to starting a shopping mall, or he doesn't know whether he should build that building or not. So he faces all those uncertainties, right? I mean, and at the point, the risk is so great that he decided, hey, guess what? I'm just going to park my money in the bank. Right? I don't know what the environment is going to be. Well, at least I know, if I park my money in the bank, at least I can earn like what, a few percentage of interest rate. And it actually can be confirmed with all those policy change adopted by the Chinese government in 2011. Right? Think about it. In the first part of 2011, the Chinese government was trying to slow down the real estate market by raising the reserve requirements, right? A couple of times in the first part of 2011, and that really gave businessmen a sense that the Chinese government is tightening monetary policy. So, which remember, man responds to incentive, right? If their long-term projects, the investment projects, have become more costly due to the raising of interest rate or reserve requirement in China's case, they're gonna cut back on their lending, right? They're gonna sense that, oh, it's cutting me off, right? So I shouldn't invest as much. But in the later part of 2011, the government sees that, oh, maybe that's not a good idea since all the business has been slowing down in China. So, the government has, started to loosen it again, right? We see the Chinese bond yield has been falling, all those signs give the business world that, hey, maybe China's gonna lower interest rate. Ooh, that's gonna, give us a really loose monetary policy, a sign of that. So they don't know, but actually they don't know whether it's going to be loose or tight, right? So there are all those predictions, but actually they don't know. So under this situation, many businessmen, like this financial institution or other business, they don't know, so they just park their money in the bank. And not only that, the Chinese government has actually been intervening in the economy at the micro level, right? Limiting how many houses people can buy, limiting how many cars people can buy, set this tax, set a property tax, set another, just keep changing stuff, right? At once, the Beijing government actually set up a lottery, in an effort to, reduce traffic jam, right? So they were trying to limit, the amount of car people can buy, so we have less car on the road, right? So there's less traffic jam, right? They actually set up this lottery, so only people who win the lottery can buy a car. Just how ridiculous was that? In the long run, that's really negative for the Chinese economy, because think about it, if businessmen are worried, they're transferring their capital away from China, they're not going to invest in China, they're going to find another place that are more certain, right? That gives them a more sense of security, a stronger property right. They're going to invest at the other place, not in China. So, as there's less investment, of course, there's a less economic growth. So, there's no way that the Chinese government can micro and macro manage the economy while achieving high economic growth. And of course, the right direction is definitely to have the government intervene in the economy less, right? That's the only way out. And another thing that I want to talk about today is gold price. Right? As we know, the gold price has been collapsing since September 2011. Well, I think a large part of this collapse is due to the speculative buying in gold price. Right? People are buying the gold with margin. Well, as the gold price starts falling, they face margin calls, right? So they have to sell their gold, right? That causes even more collapse in the price of gold. So it's like a chain reaction, right? Since the foundation of gold is based a lot on the speculation lately, right? So one collapse can create more collapses, right? But however, now we are at the point that really the collapsing has been somewhat slowed down, and more of the real buyers that buy gold with 100% down, they're coming back into the market, and some of them are new. And that's really going to build a firm foundation for the price of gold. Because face it, it's no longer a secret that these governments cannot pay their debt, right? This worry in the market really will drive up the price of gold in the long run. So I believe personally, 2012 is going to be a wonderful year for the price of gold. And thank you guys for watching. I'll be vlogging again soon, guys. Take care. And of course, remember to subscribe to my channel. Thank you very much. Have a good day.